Welcome to the Savvy Commercial Real Estate Podcast, your resource for relevant, helpful, and immediately usable information regarding all things commercial real estate. Whether you are buying, selling, financing, exchanging, managing, or developing commercial real estate, rest assured you are in the right place. Savvy Commercial. Listen, apply, repeat.
Hello, everyone, and thanks for joining us here this morning on the Savvy Commercial Real Estate Podcast. I'm your host, Neil Sherman, coming to you from beautiful Phoenix, Arizona. And as always, you can reach me anytime at info@savvycommercial.com. That's info at savvycommercial.com. Today, we're going to take a closer look at what's been happening lately with the economy, the Fed, interest rates, cap rates, both regionally and nationally, and possibly even internationally, and what sort of impact these situations are having now and might continue to have on the commercial real estate market. Joining me today to discuss all of this and more is Dr. Ted C. Jones, Chief Economist at Stewart Title, one of the quote-unquote Big Five title insurers in the United States. Dr. Jones is a 45-year veteran of the commercial real estate industry with just an amazing pedigree and background, and we're just honored to have him with us today. Dr. Ted Jones, good morning. And before the podcast, you did say I could call you Ted, correct?
You bet. You basically think a PhD, by the way, my PhD is in finance and statistics, which means I still have to pay $10 for a beer at an airport, which means it's worth nothing. If you think about it. Yeah.
Well, you heard my opening comments. Could you share with our listeners a bit more about what's been happening over the past year or two throughout the U.S. and around the world?
You know, we actually had a massive stimulus in the economy. We all know that. Pandemic came out, and for the first 2-3 months, people were scared to death. And then we saw the governments, whether it's Europe, whether it was the U.S., just an incredible amount of stimulus. So we knew immediately it was not going to be a meltdown like we saw in 2008 in that financial crisis. Although it still may come to that, depending on what inflation does. With all this money, you know, immediately with our shutdown, we realized, you know, after the first 2 months that housing was really important. And I don't mean just owned housing, rental housing, apartments and single family rentals. You know, single family rentals are the newest commercial investment segment. It was created in 2008 after that bust, when Wall Street firms realized they could buy single family homes for literally 50 cents on the dollar. BlackRock and others like that, Blackstone, their original intention was buy all these single family homes for 50 cents on the dollar. 3-4 years later, when it came back, they intended to sell them back to the people who ordinarily would own them, and they would cash out nice rent in between. But then the rent started going up so much because our economy started to grow so much and demand for housing was so much, it just blew up. And what happened immediately in the onset of the pandemic, first of all, people didn't want to live in apartments or condos, but that was the first month or two. And then all of a sudden, they wanted to live someplace that, when we realized how communicable this pandemic was, what death rates were, all that kind of stuff, they wanted to live alone. And so we saw a great big demand, increased demand for housing, even though we lost all those jobs. So that was the first component. And the next, the very first component that really exploded was industrial properties. And we know that retail properties were not going to go into furniture stores as much or anything else like that. And but we still had to shop for, you know, pharmaceuticals. We still had to shop for food and what have you. And demand for industrial properties, because of e-commerce and online sales, just exploded. And we were short in supply of that in the first place. So that exploded. And then, of course, the next one that exploded, we had rental housing and industrial properties. But, you know, hotel sector crashed and burned, and it's still down there somewhat because of lack of business travel. Although our other travel has come back rather nicely, you know, fun travel, that type thing. I don't know when offices are going to come back. You think about this. One of the big brokerage companies released a thing, and you can read it on my Twitter account. My Twitter is DRTCJ. They announced that they thought that the total value of offices in the United States of America had fallen $500 billion. And just look at the Castle link, the Castle security system cards. I tweet it about once a month. We're still not 50% back in the office. And yet, you know, we had some of the best profits in history last year of firms that ordinarily used offices. What we learned out of this debacle is we simply don't need as much office space as we used to. But which you talk about, and we'll talk later on. We're setting the stage for a massive amount of creativity and conversions of our existing properties, super regional shopping centers, offices, those type of things. Retail is actually doing quite well right now. It crashed and burned. And we switched, for example, from eating to restaurants to going through drive-throughs and takeouts and DoorDash and those type of things. That's been a renovation, a structural change in the way we use our real estate. Here's a little tidbit I want to throw you. And again, you can read all this on my Twitter account because I tweet this. I don't do a lot per month, but it's all real estate and economics. Chipotle didn't have a drive-through at any of their restaurants in 2018. It was the first time. And when they started adding drive-throughs to their existing restaurants, they all of a sudden realized their sales per store went up 15%. Can you imagine adding just a drive-through to your property? First of all, number one, you increase sales 15%. And secondly, you actually reduce the number of needed parking spots. And so we're looking at Chipotle, their new digital kitchen, the Chipotle digital kitchen design. It has a drive-up window and a walk-up window. There's no way you can go to the store. Same is true at Slotsky's sandwiches. Drive-up window and a walk-up window. Look at Chick-fil-A. Just right within a mile from my house, Chick-fil-A just converted to 3 lanes drive-through. The new 4-lane drive-through, the first concept, opened in Minnesota just 6-8 months ago. It has 4 drive-through lanes. The first one is where you order and pay. All the other 3, you literally just utilize your app on your phone, you pre-order it, and you get there, you hold it up near the device, you click your app, and down comes your food in its own custom-made food elevator. We have PF Chang's. They plan to open 50 new PF Chang's takeouts. So we've structurally changed the way we do that. We don't need as many great big restaurants. We still need them, don't get me wrong, but we've changed the way we do this. Realize it's almost been 1,000 days since this pandemic started. And they say if you do the same thing for 66 days in a row, on average, you have a new habit, lifelong habit. Man, we got lifelong habits. We're not going back to the office. We're going to do takeouts. We're going to all this type of things. We've changed. We're buying more e-commerce. But creativity and conversions, super regional shopping centers, office space, retail space, it is going to rule supreme. Just in San Antonio, large number in the past year of our extended stay hotels just converted to housing. They're small, super efficient housing units today. I think there's billions of dollars of profits to be made in conversion of commercial real estate. But then again, we have some of them that are doing great, like we talked about industrial and apartments.
Ted, you kind of hinted a little bit about what we call the I word, inflation, and the R word, recession. And since you brought those up, what are your thoughts on what's happening with regard to both inflation and recession in the greater economy, and with an emphasis on the commercial real estate world, if you don't mind?
You bet. So first of all, inflation just simply means everything costs more. And the Federal Reserve, many people may not realize this, it is a for-profit, privately owned bank. Now, the CEO and the board of directors, so to speak, the governors, they're appointed by the government, but it's a for-profit bank, and they have 2 jobs. Job number 1, full employment. Bernanke told this, he leaked this years ago. What do you define as full employment? He says when the unemployment rate's between 5 and 5.5%, which means we're better than full employment right now. And that's part of one of the reasons we're driving wages up, even though we have this inflation going, because we don't have enough workers. Part of that's because we incented so many workers either to quit working or, hey, you don't need to work anymore. We got you covered. And so that a lot of people have dropped out of the workforce. Even though today we have more jobs than any time in history, we still have a lot of people that are no longer in the workforce looking for jobs that aren't at the retirement age yet, which is pretty amazing. So going back to inflation, there are, like I said, the Federal Reserve has 2 things. Number 1, control full-time employment. We're better than that. Second one's control inflation. And again, Bernanke spilled the beans. He says he likes to keep inflation at 2% or less. Now, their definition of inflation is a little bit different than ours. You and I always look at consumer price index. Consumer price index right now says we're running about 8.2, 8.3% inflation, which is huge. When you think they think 2% is normal. The Fed likes to use a much broader version of consumer price index. It's called the Personal Consumption Expenditure Price Index, PEC. And right now it's 6.2%. They like it, keep it below 2%, which means we've got a massive amount of inflation. And here's historically what the Fed does. The Fed historically says that we're going to raise the Fed funds rate. Well, what's that? That's the target rate that the Fed says. They always do it like a 0.25% range, like 2.5 to 2.75%. That's the rate that they want banks to charge other banks for overnight loans for necessary reserves. But remember, I just told you this PCE index is 6.2, the latest one in August. Our current Fed funds rate is at 2.5 to 2.75%. Historically, the Fed will raise rates on the Fed funds target until it exceeds that PCE. Whoa. Now, if that means that the PCE index doesn't come down, we're looking at another 1.5, 2% increase in rates, which is substantial, particularly when you look at relatively good use of leverage in commercial real estate. The Fed also historically has gone where they look at the 2-year Treasury, and the 2-year Treasury is above 4% today. They normally like to keep the Fed funds rate between 200 and 300 basis points above that, which means we got another 2.5% to go on the Fed funds that gap. So I think we're going to look at a lot of tightening coming up that's coming on because of the increase in rates, which means historically we would think cap rates would go up. Cap rates aren't going up in all properties. We're looking at industrial and apartments, and they're still going down. But that's because our rents have been going up as much or more than the inflation rate. Amazing statistic. Let me pull this one up so I get the exact right number on this one. Hold on a second. This one, let me get this one here. Sorry about that. This is on apartments, and the reason we're looking at Fed funds, cap rate still doing well on apartments, and this is rent.com, and this is for September. Average 2-bedroom apartment rents in the U.S. in the last 12 months are up 23.4%. Shoot, I don't care if inflation is 10%. I'm still making lots and lots and lots of money. Now, let me give you a twist. This inflation is starting to hurt us to the point where not everyone's making that 24% more, or even the 8% more. And in the latest 1 month, remember it's up 23.4% over 12 months. Latest 1 month, it's down 2.5%. Neil, we visited just a couple of weeks ago in Phoenix and Scottsdale, and we noted that while in Phoenix, for example, rents were going up, in Scottsdale they were going down because the high end's hurting. A lot of people are saying, this inflation scares me. I don't want to spend too much money. Might want to live in Scottsdale, but I'll take a really nice apartment in Phoenix, which is a little lower rent. And we're starting to see that play out in this field. So inflation is the real big, and this one will blow you away. Now, let me put this in perspective of people buying a home. I know we're all commercial in this realm, but the Joint Committee on the Economy from Congress, they report every few months what they think inflation or deflation is costing the typical consumer. It's now $715 more to live today than a year ago per month. If you just take the current 30-year mortgage rate and you put a payment of $715 in, this inflation just reduced the borrowing power of a typical U.S. household to buy a home by over $115,000. So now we know why people are the owner housing market's cooling off. Apartment market's still doing relatively well, particularly on the lower end, because people have to live someplace. But it's inflation that's really hurting a lot of this. I actually think the culprit right now, it's not the economy, it's inflation. And the Fed kind of disappointed me. I'd hoped they were going to raise 100 basis points this last move to tell the world that we're going to do something about this inflation. They haven't gotten ahead of it yet. Inflation is still running pretty rampant. That's a big concern I have. One of my biggest concerns.
Ted, before this call, I Googled recession, just because you can't pick up any newspaper or turn on the news without hearing about a recession. And I was reading the, kind of generally accepted definition of 2 consecutive quarters of decline in the gross domestic product. As an economist, do you agree with that definition? Do you have your own definition? What are your thoughts on that?
Well, the last 10 recessions, not only has the Fed agreed with that definition, but even then Vice President Biden agreed with it, then President Obama agreed with it. And in the past 3 to 5 years, Speaker of the House Nancy Pelosi's agreed with that. So if you have 2 or more consecutive quarters of negative GDP, and GDP is simply the value of all the goods and services we produce on an after inflation basis, and that's the key. Our GDP is technically rising, but it's not keeping up with inflation. And that's why we have the negative GDP. And yes, we've hit that hurdle. Now, there's a second thing that's always gone on. Also, in the last 10 recessions, we had what's called the inverted yield curve. Historically, the longer you borrow money for, the more you pay for it, interest rate wise. Short-term borrowing's a lower rate because it's not as risky. When in each of the prior 10 recessions, we had an inverted yield curve, which means short-term borrowing was more than long-term borrowing. We have that today. So we have the 2 leading indicators of being in a recession. And I've been saying since literally April, we're in a recession. Thus far, it hasn't been major job losses. We're starting to see that. Look at the U.S., we'll look at the residential lending industry. Because of rising rates, residential lending is going to be about 50% this year what it was last year, which means half of all residential loan officers, if they're not already out of a job, they will be shortly. And so we're starting to see some layoffs taking place. The tech industry too. The tech sector is sitting here saying, we're going to hone down and we're going to really tighten our spending. And we're seeing, and that means you're reducing people. Let's be honest about it. For many businesses, your employees are well over half your expenses. And so we're seeing that, and we're seeing some layoffs starting to take place. I expect that our unemployment rate will increase. I think it's actually good. And the problem, though, is our unemployment increases, then we literally see the stock market decline more. Now, one of my best forecasts I made a year ago, July, I said that the stock markets with the next 24 to 30 months, somewhere in there, would drop at least 15 to 30%. NASDAQ's already down 30+%. The S&P 500 is down over 20%. And then just 2 weeks ago, Goldman Sachs came out with a note to their investors that deal with that bank, that investment bank, stating that if the Fed does go and gets inflation down to, unemployment down to 5%, then we're going to lose another 14% in the S&P 500. And if they go to a 6% unemployment rate, we'll lose another 27%. That sets the stage for ongoing declines in jobs, because when you see the stock market continue to go down, we see people's net wealth go down and net worth go down. They don't spend money as freely, and that causes GDP to shrink, and that causes recessions. So it's kind of like a self-fulfilling documentary, if you think about that, a philosophy that I think we're in some tougher times than most people think. There's even rumors on Wall Street in both Europe and the U.S. today that some investment banks may be close to failing. That's kind of scary, because we certainly don't want to see 2008 come back all over again.
Ted, I want to shift gears just for a little bit and touch on something you brought up earlier in your opening when you were kind of setting the table, so to speak. And you brought up the term conversions. We're seeing cranes all over the country. I know you travel, I travel, wherever you go, tons of cranes all over the cityscape, the landscape, if you will. But maybe on more of a lower density basis where you don't maybe see as many cranes, you're still seeing a lot of these conversions. Malls come to mind, hotels, office buildings, you mentioned those earlier. What are your thoughts on adaptive reuse or conversions overall regardless of whether they're going, up high enough to need cranes or whether they're just, a single story, 2-3 story property that's being converted to some other use right now?
I think it's the biggest growth mode in commercial real estate we're going to see in the next decade. And it's just really starting. Google and Amazon have converted 38 super regional shopping centers into industrial distribution centers. We've actually done some title policies on the West Coast of the U.S. They're converting, for example, one group, a hospital, is buying half of a super regional shopping center. Bottom floor is going to be pharmacies and gift shops and workout rooms and restaurants and what have you. There'll be a walk-in clinic. Second floor will be day surgeries and treatment centers and what have you. The third floor will be lab work and stuff, and the fourth floor will be office space for medical. We're seeing another one that we looked at, issued a policy on for conversion. Entire super regional shopping center, kind of the same thing, but this one's going to go to education by a major university and also by a community college. Hope that, assuming that comes about in the plans, what they're going to do again, the first floor is going to be bookstores and workout facilities and restaurants and movie theaters and fun things that college students do that to, cafeterias, all that type of thing. But second floor, third floor will be all classrooms. Fourth floor will be all administration. We know of properties on the East Coast. One building in particular, 18 floors, was an office building, according to the security cards that go in and out on a given day during the business week, 3% occupancy. The East Coast, like Boston, is really short on lab space. Converting a large number of buildings to completely new lab space. And think about this, it's lab space central, so it'll be not just coronavirus testing, but dental labs and medical labs and all the type of labs that you realize that we need in our society, hospital labs and what have you. And yet all those people are together in one structure. So if you need another opinion or what have you, just down the hallway or on the next floor or whatever. So I think that conversions, retail space conversions, I think of Simon. One thinks, well, wow, Simon, you're in trouble. You're the largest owner of super regional shopping centers in the country. It's also one of the more innovative companies. They have an anchor tenant leave, and they'll literally fill that big anchor tenant full of 30 to 40, who knows, depending on the size, restaurants, bars, entertainment. Now, during the, I wouldn't say the pandemic that didn't work, but that certainly is booming right now. But again, I think that we have this massive conversion potential. And I think there's going to be more money made in conversions the next year, creativity and repurposing building. And we've seen it in the past, over the last 40, 50 years when we took industrial buildings and we made residential lofts. We're going to see a lot more of those type things. And that's just great use. First of all, let's admit it, we still have supply chain shortages, particularly if you include labor in the supply chain and now capital, because as rates go up, our lenders become much more restrictive on this thing. And it just takes a lot less materials and a lot less labor to convert an existing structure than to build a whole new structure up, or to tear down a current structure and build a whole new structure up. So adaptive reuse and the creativity there, Neil, I think the people that are really have a vision for the future are going to make piles of money. They're going to be pretty money. And I think that's great news for both the environment, you not have as many new materials and everything else like that, the economy, in particular opportunities for commercial real estate professionals and investors.
Ted, thank you for that. I wanted to talk a little bit about the current state of the commercial real estate market, if you don't mind. You talked at the very beginning about where the world has been over the last 2 to 3 years. Maybe you could drill down a little bit and talk about where, commercial real estate has been over the last maybe 12 to 24, maybe even 36 months, not just, regionally, but nationally. And where do you see it heading today, right now? And one more thing, I guess, I know you don't have a crystal ball, but do you have any either predictions or projections concerning the commercial real estate market going forward over the next year or two, based on what you're seeing today?
So I'm gonna do a little bit of history first, and let's back up. In the fourth quarter of 2021, And these are real capital analytic data. They're the best data I think that money can buy. I really love their data sets, what have you. They're very accurate. They update them continually, even going back multiple years when they find new data. I like that. And this is an amazing thing. In the fourth quarter last year, we sold over $900 billion in the prior 12 months, but it was the biggest fourth quarter in history, period. Almost double what we used to think was a great quarter. In other words, it was almost double. If you gone back the prior 10 years, it was more than double what the average quarter was in any prior 10 years. So that was good news. Second one, well, let's just look year to date. And the latest year to date numbers from Real Capital Analytics are August. Here's some great news. Latest 12 months, latest year to date through August this year compared to last year, up 22%. Wow. But now let's look at August. August this year compared to August last year, down 41%. So we're seeing the commercial markets cool rather dramatically. In talking with commercial professionals out there, a lot of it is their sources of financing have dried up. Hard to do a commercial transaction if you're going to try to borrow 40 or 50%. It's just not possible. If you want to look at year over year, other than senior housing and care, every segment's up. Office sales were up 3% year over year. But remember, a year ago, in the first part of 2021, nobody was buying offices. Retail's up 57%. You say, wow, Ted, that doesn't make sense. And remember, this is year to date. Yeah, it does. Because all the stimulus spending and all the jobs we got more jobs than any time in history, but we have better jobs than we ever have. Tragically, the people who lost their jobs in the pandemic initially and haven't gotten them back are the people who could have least afforded to have lost their jobs. These were hotel workers, minimum wage, minimum skill set workers. They didn't have 401ks. They didn't have health care. They didn't have benefits. They didn't have paid vacation. They don't have a job still today. Check into a hotel and ask them what percent of your housekeeping staff you brought back, and I'll fall over if they say more than 50%. I'm talking even high-end hotels. But retail's up 57%. Industrial's up 19% year over year. And remember, industrial was hot last year. Hotels are up 2%, but 2% of nothing is still nothing. I had to say that. With business travel and hotels. Tourist travel and hotels, completely different bailiwick, completely different segment. But even the CEO of United Airlines believes that we will never get back to the level of business travel we used to have. I think that's true because look what we're doing today that we used to get together in the meeting room and fly over the country to do. We're going to do it electronically. Technology is changing the way we do business. Apartment sales are up 32%. Senior housing and care up down 33%. And development sites are up 20%. That's neat to see land coming back into the picture. Okay, that's year to date. Now let me give you the August ones. Office sales down 56% this August compared to last year. Retail down 43%. Industrial is down 63%. That's because nobody wants to sell their industrial because rents are going up so doggone much that real limited supply. We think we're at the lowest national level of vacancy rates on industrial we've ever seen in history. And mind you, there's a lot in the pipeline under construction, but we still going to look at the next couple of quarters of rent increases. And the reason that people are buying certain parts or not selling certain parts of commercial real estate, historically in inflationary periods, we see commercial real estate outperforming the rate of inflation, or at least keeping up with it. Apartment sales year over year down 26%. Again, we're seeing a cooling, particularly on the high end there. And development sites down 67% in August. One of the first things that dries up in financing is for developmental land because it's speculative. That's a lot longer play, a lot more risk than just building a new building. And we're seeing that take place in this commercial sales market. That's not true in every market. We're still seeing a lot of markets that are literally selling more commercial real estate in the prior 12 months in any period of time. Shoot, like I say, when I was with you, Neil, bingo. In Houston, Texas, bingo. In Dallas, Texas, bingo. Nashville is doing great. Just depends on where you're at, what type of property selling in that mix.
Well, you actually just segued perfectly into my next question for you, which is, are there any cities, states, or regions which, in your opinion, have either benefited the most or fared the worst as a direct or indirect result of such things as what we've been talking about: COVID, inflation, recessionary fears, any other occurrences. Speak a little bit about that if you can, on a city, state, and regional basis. Who's fared the best, who's fared the worst as a result of those things those occurrences that we talked about.
So, this pandemic didn't create a lot of new trends, but it sure did accelerate some. One of them was where people are moving to. For 50 years, people have been leaving California, going to the Southwest and Pacific Northwest. For 50 years, people have left the Northeast corridor. They left Connecticut and Massachusetts and New York and New Jersey and Maryland. Yes, you're supposed to laugh at Massachusetts. And they've been heading to the Sun Belt in Florida, heading to Florida anyway until this last tragedy of the climate. And I mean, hurricanes have happened for thousands of years. It just happened again. But let's talk population. Now, every year, the Census Bureau actually goes out and they estimate the population between July 1. So the latest data we have is between July 1, 2020 and July 1, 2021. In that period, the latest full year of data we have through 2021, July, the U.S. grew at the lowest population growth rate in the history of the country. They grew 0.1%. And here's the top population growth states. Number 1, Idaho, up 2.9%. That's 29 times the population rate of the U.S. Utah and Montana both up 1.7%, 17 times. Arizona, 4th best in the country where you're at, Neil, up 1.4%. That's 14 times the U.S. growth rate. South Carolina, Delaware, both 1.2%. Texas, 1.1%. That's 11 times. And then you look at Florida and Nevada, 10 times at 1%. Now, here's where people are leaving. And when we look at this, either aging or they're leaving or both. And the District of Columbia, I know it's not a state, they're down 2.9%. And can you imagine losing 3 out of every 100 people in 1 year? That's essentially what happened to D.C. New York's down 1.6%. That's 16 times the national growth rate, negative though. Oh, and one of the estimates is in Manhattan Island, 5.9% of all the people that live there before the pandemic don't live there anymore. Man, you talk about a structural change in that.
Sure.
But first of all, population, I know population is not the biggest indicator, but one of the next ones we have are jobs. And so let's take a look at the job growth. Oh, and we're going to look at job growth a little differently. We know everyone lost jobs during the pandemic. The U.S. lost about 23 million jobs in 50 days. Think about that. In the 2008 Great Recession, over a 24-month period, we lost 8 million jobs. At the start of the pandemic, in March and April of 2020, we lost 23 million jobs in 50 days. And so we don't care about jobs. Everyone lost jobs, some more than others. I care about the ones that now have more jobs than they ever did before. And we now have 20 states today, when we compare jobs as of August this year to February of 2020, that's the month before the pandemic, that have more jobs than ever before in history. Utah is up 6.7% and Idaho is up 6.3%. Now, let me throw that in. That's technology. Those two markets, along with places like Austin, Texas, Fort Collins, Colorado, and a few other areas, are the new tech centers. People are leaving, Silicon Valley, and they're going to lower cost environments. They're going to lower crime environments, lower density environments, and that's where they're heading. And Texas, Utah's up 6.7% compared to before the pandemic. Idaho 6.3%, Texas 4.3%, Florida, until this hurricane, and I'll talk about that in a second, 4.1%. North Carolina, I love the Carolinas. The Carolinas, you look at all the major universities in those towns that are high tech. You even drop down to Georgia Tech and states like that. Georgia's 3.4%, Arizona's 3.1%. Tennessee, you talk about a hot state. Tennessee's up 2.8%. Arkansas, that'll blow you away, 2.4%. South Dakota, 2.1%. I'm going to give you a hint, and we have time to talk about it. That's because they had the second lowest business taxes in the United States of America. And they're kind of right next door to Minnesota, which has the 6th highest, according to the Tax Foundation. And people realize particularly higher income people, they can save tens, if not hundreds, if not millions of dollars per year, moving just across 2 hours away. And people are doing that.
And what about number one? Did you mention number one? Who's ahead of South Dakota?
Oh,
Corporate
Wyoming.
tax.
Wyoming. Wyoming has the lowest corporate taxes in business taxes. Like the Tax Foundation does. Well, I'll do a segue here because we're pretty good on this list. Tax Foundation every year, they're not for profit out of Washington, D.C. They look at 5 taxes: personal income tax, personal income tax, corporate income tax, retail sales tax, unemployment tax, and property tax. Lowest in the country is Wyoming. Oh, and that'll also tell you why places like Jackson Hole, Wyoming, median home price earlier this year was $3.85 million. That includes 1-bedroom condos. Think about that. And that's because you get high income individuals that can move to a state with almost no state taxes whatsoever. Beautiful place to live certain times of year, whether you like the wintertime, whether you like summertime, and they can avoid the state taxes almost completely legally. I don't believe in illegally avoiding taxes, but they can do it legally. The problem is you get to Jackson, Wyoming, 95% of the housing is predominantly second homes or third or fourth homes for the very wealthy. And the locals who want to live there, they can't afford a place to even rent. Many of them literally sleep in their trucks and cars in the summertime and sometimes even in the wintertime. But so taxes do make a difference. Florida, third lowest is Alaska, unless you're a caribou hunter or a fly fisherman or whatever, you don't care. Fourth lowest was Florida. And Florida had a hot economy, both job-wise and everything else like that. Throw in the highest income tax states, and according to the Tax Foundation study, not just income taxes, 5 taxes. Number 1, New Jersey. Number 2, California. Number 3, New York. 4, Connecticut. 5, Maryland. And 6, Minnesota. So taxes have made a difference as people decided in this. I can not work from home. I can work from any place. They've made a difference where people relocated, not just themselves, but their businesses too. Look at Austin, Texas. You got 6 Silicon Valley companies that are in the process of relocating their entire operations out of Silicon Valley into Austin, Texas. It's been a hot market, but it's cooling off a little bit too with this inflation going on.
Ted, I've been reading a little bit lately about construction costs, supply chain issues, and so on. As we both know, those were just out of control a year or two ago, maybe even 8-9 months ago. But for the builders and developers who are going to be listening to this show, can you speak a little bit about either construction costs or supply chain issues? I've been hearing lumber, for example. The cost of lumber is almost back to pre-pandemic pricing. I don't know about other construction materials. I seem to hear about lumber more than anything else. And then, of course, you've got supply chain issues, which have been behind not only material costs, but just about every other cost. Can you speak a little bit about those 2 issues?
You bet. First of all, you're correct about lumber. It's kind of getting back to it, but you have to be careful. Last November, and this is going to go more in apartments, some in interior finishes and buildings, although it's mainly still studying that type of thing, still framing. But last November, the executive order from the White House doubled the tariff on imported softwood for framing materials from Canada. We're talking 2x4s and things like that, which go into a lot of apartments, a lot of housing. We went from 9% to 17.9%. National Association of Home Builders said that we just raised the cost of the typical apartment or house by about 4% just from that alone. Good news is we are starting to see some materials, tiles, electrical fixtures, everything else, light fixtures, appliances become available. The bad news is not to the extent that we used to have. Still, just a couple of months ago, my wife and I's cooktop went out. Went down to the appliance store to get a new island cooktop, all that type of stuff. And we ordered it, actually paid for it. And then she says, good news, it'll be in 4 months. And I said, 4 months? And she says, good thing you didn't buy the Sub-Zero. And I said, why not? She says, 12 to 14 month standing orders. So I want to put myself in a developer's position. First of all, I'm looking right now today, okay, I can get wood at what I used to pay for it. Unless you're doing houses or apartments, not a lot of use there. Because most of that stuff, well, maybe some office, small 1-story stuff, but a lot of that stuff's going to be steel framing and everything else. Secondly, even if I can get those materials, there's no more plumbers, there's no more electricians, there's no certified pipeline welders coming out because they're all gainfully employed. A lot of people that used to do that retired, went elsewhere, started a new business, too hard to work. And a lot of people in construction. Let's go back to 2007, 2006. We built and sold 2.1 million new homes. At the bottom of the Great Recession, we dropped all the way down to less than 400,000. And all those people that built those homes, and not even apartments, there's a lot more of those, they went out and got another job. They're truck drivers today. They're not going back to work out those elements. So it's not just supply chain, it's actually skilled labor shortages are doing that. I had a friend, and this was in Florida, and it was last year, but had a complete 300 unit new apartment project completely done, simply could not get the couple 100-ton AC units they needed to get approval. You know what it is to sit there on a completed project and you're sitting there waiting for your refrigeration pumps outside, your compressors and everything else, evaporators, the whole works. And you're running a tab, you can't rent your property, you're paying interest on your loan you never imagined, and you're paying a lot more for those units when they finally came in, and they weren't even to the specs they wanted, so they're not as efficient, and you go on and on and on. Been a very challenging period for developers. And that was true too, Neil, on development land. We came into 2008 with a glut of land, developed lots. We chewed them all up, and we've been behind the curve on that since that started. And kind of intriguing that we're sitting there developing. Developers you talk about a unique breed of cat. Some people drill oil wells, some people go to Vegas and play craps. The developers like to play land poker. And it's a tough game. And the difference is, at least when you lose in craps in Vegas, you get a free drink. You don't get a free drink when you lose on land poker. So yeah, but yeah, those should be very high return markets because they're high risk.
Well, Ted, as we start to wind down our show just a little bit, I've got a couple of questions for you that are going to be maybe a little bit more personal. You're free not to answer them if you don't want. But my first one is this. You're a top U.S. economist. You've forgotten more than what most of us know. We'd like to know what specifically keeps you up at night with all that you're currently tracking across the country and around the world. What, if anything, is getting you to lose any sleep, whether you're, investing in commercial real estate, whether you're a banker, whatever you are, what's keeping Ted Jones up at night with regard to what's happening in the world right now?
I think the biggest issue facing the world right now is this inflation factor. You can actually make inflation built into your system. We're looking at well over an 8% rate right now. For the consumers, it's costing 8% more, $715 more for the typical household to live compared to a year ago. And they're not making $715 more. But let's just say the employers finally say, hey, I got to keep my employees. I'll pay you the 8%. But that means they have to charge more for everything else. All of a sudden, you just internalized inflation. And it's really difficult to come out of that cycle when you realize we built in a mechanism that perpetuates inflation. So I think the biggest issue facing this world right now, is inflation. In the U.S., it's inflation too, but I think I have two long-term issues that I really worry about. One of them is crime. And I'm not talking politically. I'm talking about, when I was a kid, and granted, I grew up on a sheep ranch in southwestern Colorado in the mountains. But my friends in town, when they were 8 or 9 years old, they'd disappear in the summertime at 7:30 in the morning, come back at 7:30 at night, and no one cared. My goodness, you won't even leave your 10-year-old alone in your backyard, your own private backyard with heavy fencing today. This crime thing is out of control, and it's destroying society. The second one, and this is a big concern, this is not, again, a political statement. We have spent billions, if not trillions of dollars on renewable energy. And we're now looking at dichotomization of energy. One is called reliable. Coal-fired plants are reliable. Nuclear plants are reliable. Natural gas-fired plants are reliable. The unreliable side, where we spend all this money, and don't want to say unreliable, it doesn't run 24/7, 365. The wind doesn't always blow for wind turbines. The sun doesn't always shine for solar collectors. So you get these massive peaks of energy that come off those, and you get periods where there's absolutely no energy. So we haven't spent any money on the grid. the grid is a big issue. If we're going to run this country down the long run, and particularly if you want to go to the unreliables, you have to have, if you only get water 6 hours a day or 12 hours a day at your house, you got to have bigger pipe. Instead of it flowing in all the time, you're going to have a bigger pipe to store it someplace. Same is true with our power line. But one of the estimates is that if you have a level 3 charger for an electric vehicle, and this came from the Wall Street Journal and USA Today, so this isn't off the wall, anarchist or whatever. They say if you plug your car, the neat thing about electric vehicles, a level 3 charger will charge in 20 to 40 minutes. Right? Only if you don't have a level 3 charger, if you plug in the AC in your wall, every 8 hours you'll get about 50 miles of total battery storage of mileage. That's horrible. I couldn't live like that in my lifestyle. I couldn't even get to the airport on an 8-hour charge. But they say if you're using a level 3 charger in your neighborhood that charges that car in 20 to 40 minutes, your house is now using as much electricity as 55 surrounding homes. Our neighborhoods weren't built with grids where you get 10 homes that might be charging out of 55, say in California eventually, or not eventually, but maybe even sooner we think. And all of a sudden you're using 10 times more energy than that grid was designed for. We don't have the grid to support it. One of the estimates, and again on my Twitter account, DRTCJ, and you'll see the source on this one in the last couple of months, they estimate that we need to spend $1.5 to $3 trillion on the grid between now and 2030 just to keep it running. And so I think that we've got some issues that we need to take care of. And it's not going to be a panacea that just plug in everything that's going to work. You have to have the generation, you have to have the grid to distribute it. So those are my big things. Inflation, I think that the grid, and reliable energy is going to be a critical force. Crime. I am also kind of a little worried what have our investment bankers done this period. As I started to say at the earliest part, we're hearing whispers, both on Wall Street and in Europe, that we may have some investment banks that are getting close to the edge. And you'd hate to see all that happen again, wouldn't we? So not going to, until we get facts or anything else like that, not going to say that, but we've had a lot of people that expose a lot of risk in their investment portfolios without question.
Thanks for that, Ted. Well, I think we're down to our last question of the show. And, you've talked about, I've taken a lot of notes. You've talked about interest rates, cap rates, inflation, recession, quitting culture, developers, builders, et cetera. I mean, just all kinds of stuff. You've been unbelievably helpful in this call, on this call. But I'm going to ask you to go on a little bit on a limb and tell us and our listeners what they should be buying, selling, or building currently. And I guess a part 2 to that question should be, or is, how should they be financing these? I mean, are interest rates going to continue going up, and in which case they should be locking long-term rates now? Are interest rates possibly going to come back again, in which case they maybe should be looking at more short-term rates for these projects? So if you could speak to the buying, selling, or building, as well as how would you finance those projects?
I'm going to twist this around a little bit on this one. My favorite investment right now in my portfolio, overweighted that, are Class B and C apartments. And why do I like B and C apartments so much? These are apartments that have Formica countertops and vinyl floors. They don't have granite or quartz. They don't have the marble floors or anything else. These are apartments that the typical workforce person, their family, their households live in the United States of America. I like them because we haven't built one of those in 20 years. Our land costs are so great. If you want to build new apartments, Dave, your land is so high, you are forced to build A apartments in most circumstances. And so I love B and C apartments. In fact, we've torn down a large number of B and C apartments because we're in such great locations to build new stuff, including new Class A apartments. And so just from Econ 101, supply and demand, if you're going to have some tough times coming up, even good times, B and C apartment demand growth will increase, but supply will decrease because we're just not building anymore. So that's my favorite investment. On the financing side, of course, commercial is so different from the rest of the world. Most of our loans are not fully amortizing. Most of them are 10 years in duration. Most of them have pretty material prepayment penalties. And so, if you can refinance today and not do that, or if you can refinance in the future and not do a prepayment penalty, maybe if you're negotiating a rate today without a prepayment penalty, there's some room to sway in there. We do need to pay attention to, we're always used to going down to our local bank and getting a loan and what have you. We need to go back to a lot of private equity is going to come into play on some of this stuff. We're going to do a lot of mezzanine financing. We're going to do a lot of life company financing. Life companies are a really different entity. They're in it for a long-term investment, but not real high rates. When I think of typical life insurance policy, they need to net between 2.5% and 4.5% over a 25-year period or 30-year period. Those are the old numbers anyway. So I think life companies are going to be a really good source, but they're only going to take the best transactions. Local bankers, and don't blame your local banker as the Fed tries to cool the economy, as they pull, not quantitative easing where they gave the banks every month they'd go in and buy $120 billion worth of mortgage-backed securities and treasuries. The banks would have another $120 billion every month. This is just the opposite. The Fed's going up to today and say, here's some treasuries, give us your money. Oh, by the way, hold those treasuries. So don't blame your local banker if he says, I just don't have the money to do that right now, because the Fed's playing the moral suasion game and the quantitative tightening game on the bankers, reducing their liquidity. And so bankers are going to try to naturally hunker down and avoid some of those risks too. Bankers aren't risk animals. They're actually very astute investors, ones that I've met over time that have been successful. And when things are good, they'll play with you. And when things are bad, they've got to survive. So I think on the financing side, I think we're going to look at a lot of, I think LLC is going to be another great new avenue. But most of my B and C apartments investments are LLCs. And so I'm dealing with passive gains and passive losses. And even without all the tax benefits that have long-term been associated with that, it's still a very lucrative investment. So I think we need to be creative. And that is going to require some talent. It's going to require some talent from commercial people that understand how to package that from the tax side and from the legal side. You're going to have a team today to do some of these investments in the future.
Ted, real quick, can you give us a number 2 and number 3, if you have one, after B&C Apartments, as to what else for those people who might not want to jump into multifamily, or maybe have never owned multifamily and are a little hesitant? What would be your number 2 and number 3 investments in commercial real estate these days?
I love industrial property still. And the reason is, I think as we continue more towards e-commerce, and it's just going to do nothing but grow. It's on an upward trend. Granted, it's not to where it was in Q2 2020 when we just literally sat at home and did everything e-commerce. But I think that well-situated e-commerce facilities that make sense are great investments. Let me tell you, when I wrote commercial appraisals, and I've done everything from solid rocket missile plants on, I always evaluated. I call it my 3Q page. I look at the quality. I look at the quality of the location. I don't care what kind of property it is. If it's in a great location, I'm probably going after it. I look at the quality of the property. I don't want some 20-foot industrial warehouse properties, because, if you're not 36 right now, you're not even in the game. So the quality of the property. But the third biggest thing, and no one seems to talk about this, I want to know about the quality of the tenant. Let's say you got a little retail strip center. Let me define a typical retail strip center. It's got a sandwich shop, it's got a nail shop, it's got this one and this one. Nope, I pass on that one. The one I go after is the one that has FedEx on the corner. It may still have a sandwich shop and it may still have a nail shop, but they will have traffic in and out of there every day on FedEx, which drives traffic to those other retailers in that. That's that quality of tenant mix. And that's where the real consummate commercial property manager comes into play, understanding the synergies between those tenants, that mix. And I think the value add there is extremely high from the consummate commercial property manager in the mix of tenants and the quality that they have. So I go after 3 key: location, quality of location, quality of property, and quality of tenant. And I'm willing to look at anything in that mix as long as those 3 come into play.
Ted, real quick, just on that quality of tenant, I haven't heard you say much today about single tenant net lease with a national or at least a very strong regional credit tenant. And I've seen a lot of people getting out of such things as even multifamily and other property types to get into these quote-unquote coupon clippers or mailbox money where they buy, just going to throw out a name, a Walgreens, for example, or a very high-end fast food restaurant, the ones, the national chains and so on. What about those as a safe investment if people are looking for a little bit of refuge maybe from the storm? Should they be looking at putting money into these, especially if they're getting nothing in their bank accounts and money market accounts and so on? You could still get anywhere from 3-4% returns, maybe to 6 or 7% returns if you're lucky, without too much risk on the tenant. What do you think about that type of investment?
So I love triple net leases. I always like those. They're single standalone properties. You nailed it when you said they'll get 3, 4, maybe 5%. And problem is the one that's yielding 3% that's not in that quality location. It might be a quality tenant, but what it says to me is let's look at, you mentioned Walgreens. Let's look at the drugstore industry. We're seeing continued consolidation in that industry. We're seeing all the major players shutting down operations. All right, they're a quality tenant. They'll pay that landlord that 3% or whatever it is for the next 11 years of lease. Well, if you're not in a good location, tell me the value of that property afterwards. So I'll go back to my 3 keys. I love triple net. I think there's great opportunities. I think that we have seen what we thought were quality landlords that are no longer in business at all. And it looks really good on paper, but even if I'm going to get a triple net lease, which I like, I want to make sure it passes my 3Q test. Just because you got a quality tenant doesn't mean it's necessarily a good investment.
Sure, absolutely. Well, Ted, again, you've done a phenomenal job. You, like I said, have forgotten more than most of us know about this stuff. I thank you again for joining our call and our show today. I want to remind all of our listeners that they can follow you on DRTCJ. That's your Twitter handle, correct? Okay. Well, Dr. Ted C. Jones with Stewart Title, Chief Economist with Stewart Title. Thanks for joining us today, and we hope to hear from you again in the future.
Honored to be here, Neil. Thank you very much. Keep up the good work, man.
Thank you. Take care. Bye-bye.
Yeah, and then hit stop.
This one?
Yep.